Bear Market Watch 2019. Here we are back again with AK Fallible, your host, checking to see if we're in a bear market yet. This is the #1 question I get asked all the time, and putting 2019 bear market crash in my video titles gets me a lot of views, so I'll keep answering this question over and over. But no, it's good to review the market, so let's get into it. And who better to help us in reviewing the market other than the amazing, talented Alex Barrow from MacroOps, the #1 macro analyst that I personally know. I'd say he's top 5 on the internet though. Plus he has his unique military background. If you didn't know, he was a special operations sniper, then he did intelligence for the US forces, and then he worked at the FBI doing secret stuff. Really, he did a bunch of secret stuff all around, but he's a complete badass. And he doesn't like to talk about it because I guess he's too humble, doesn't like to toot his own horn. But I have no problem tooting his horn. You know, watching too much Arrested Development lately. Turning into Tobias. Anyway, let's jump into it. So here's Alex's latest market brief titled Investors Love Cash. So the first thing we're gonna go over, like we always do in all these videos, is sentiment. And Alex here lists the latest results of the Bank of America Merrill Lynch Fund Manager Survey. That's what BofAML stands for. Thank God for acronyms, right? So the number of fund managers overweight cash is at its highest level since January 09. That being close to the bottom of the financial crisis. And fund managers continue to allocate in preparation for a secular stagnation. So they're long cash, pharma, discretionary, EM, REITs, and their big shorts are cyclical sectors like energy and industrials. So basically what the survey is saying that based off these guys' positioning, they're positioned for a worse economy. They think a bear market is coming. See, their global growth expectations rose in February, but just modestly, and it's coming from an extremely low level. 2/3 of managers still expect slower growth in the next 12 months. They're bearish on the economy. 34% of respondents believe the S&P 500 is peaked at 2931. That's up from 11% of September of last year. So Alex says the most important takeaways in his opinion are the strong overweighting to cash and the now crowded positioning in emerging markets. So like we just mentioned, we're at the highest cash level since January 2009. And we say this in every single video. This is not how market tops are formed. They don't die on excessive pessimism. They die on excessive optimism and euphoria. So you've seen Wolf of Wall Street, right? Things were pretty amazing for Leo before they got really bad, with the office parties and the midgets, or sorry, small people, and the strippers in the office, and you know, you saw those scenes. After that euphoria is when everything came crashing down. Same way it works in the markets. Just remember Leo. See, Alex says right here, for a significant bear market and or market crash, you need to have excessive risk taking and over positioning. For example, the use of leverage, which leads investors to get over their skis. And what he means by investors being over their skis is that they're taking too much risk. So when the euphoria strikes, everyone starts leveraging up, right? You saw that in Bitcoin, where people were taking out second mortgages. They were taking on credit card debt. They were doing all these crazy things just so they could buy more Bitcoin because it was going up, up, and up. And you need that type of leverage and stupidity for the crash to come, because as fast as it forces things up, when it turns around, the crash is just as fast, even much, much faster. And that speed is because people are so over levered. But obviously the precursor for that to happen is leveraging up in the first place. And that's exactly what Alex is talking about. And here's a good graphic that just shows how much cash is on the sidelines. This is the largest point since 09 over here. So again, according to the survey, the US saw record equity outflows over the past 3 months, totaling 82 billion. So this amount of outflow is actually consistent with major bottoms in the past. You can see they're circled all right here. Of course, it can go much lower as it did with the great financial crisis, but this gives us an idea that it is getting pretty low. And by low, I mean redemptions are increasing, because that 82 billion was equivalent to 2% of AUM, which is assets under management across the industry. People are scared and pulling their money out. And that money that's rotating out of US stocks is going into emerging markets. So cumulative EM bond and equity inflows are now just 2 billion from all-time highs. You can see that right here in this chart. So when you put it all together, fund managers are being defensive. They're holding a bunch of cash and little equities, but they're holding a relatively large amount of emerging market debt and equities, probably because they think they're cheap compared to US valuations. And the survey actually shows that fund managers are now overweight emerging markets and underweight US equities. So if all these people are piled into emerging markets, then there's really only one way to go, right? Out of emerging markets. So that's why it acts as a headwind now for those markets. But as for the US markets, they're all underweighted, so the only way to go is into the markets. And that acts as a tailwind that should push US markets higher as they make the shift. And now if we look at retail traders, and to do that we could look at TD Ameritrade's Investor Movement Index, you can see this thing is hitting multi-year lows. Now this is still a sentiment chart, but it's based on where these people are actually putting their money. So if it's hitting lows, then that means that retail investors are pretty bearish about the market too. They have cash on the sidelines. So both professionals and retail guys are very bearish on the market. And like I've said, with sentiment, it's the opposite. If people are super bearish, then that likely means good things for the market ahead. It's just all about climbing that wall of worry. So if we look at the technical picture of the market, the S&P is bumping up against its 200-day moving average. I know it says week here, but he meant day. So if we close above that level, that's a significant signal that we're back to the races, the bull is back on. And then another thing we like to look at is breadth. And the breadth indicators are showing a lot of strength. Right here, we see the MCSI making a huge reversal. That's good news for the stock market. Another thing we could look at is the straight up advanced decline line, and that is making new highs too, which is another bullish sign for stocks. And the advanced decline line, all that shows is how many stocks are advancing versus how many are declining. So for a bull market to sustain itself, you want a large group of stocks all moving up together, not just a few big stocks pulling the market behind it. You want that breadth. That's what we're always talking about when we say breadth. And here you could take a look at the Fed's financial stress index, and you can see that it's rolling over again, like it's done at every major bottom. So Alex sums it up here. He says we have fund managers holding near record levels of cash, and they're overweight emerging market stocks and bonds and underweight US stocks. Then we have data showing that retail investors are at multi-year low levels of positioning in equities, and multiple technical indicators are showing extremely strong market breadth, which in the past has typically led to a sustained rally higher. Plus, we have financial conditions easing. Alex makes a great point here that's really interesting. He says one thing that's keeping this old bull market in US stocks alive is the constant worry over politics and economic policy. The World Economic Policy Uncertainty Index is now at all-time highs, and we see that right here. Here's where Trump won, shot up a little bit after that, dropped, back up at highs again. So this underlying concern over geopolitics is keeping investors from getting over their skis, which has kept these mini bear market sell-offs, like the one we just saw, from turning into larger self-reinforcing cyclical bears. No one's getting over leveraged because they're scared. And until they do get over leveraged, when all their fears are gone, we're not gonna see a real bear market. So there you have it. That's your answer. The bull is alive and well. You're happy, right? Unless you're a perma bear. Or maybe you might be sad if you missed out on this recent rally. You might be feeling like you missed out. But don't worry. If you're feeling like that, I've got the perfect guide to help you. It's free, and you can get it if you just type in your email, and you can find that page where you can do that either in this video or down below. The links are everywhere. But this guide will give you some strategies to get rid of that FOMO you're feeling, because FOMO is one of the feelings that makes you do stupid things in the market, makes you break your strategy and then you regret it later. So it's important to know how to prevent that, or if you already have it, how to get rid of it. So go ahead and get that guide. It's free. I'll send it to you. And if you haven't already, make sure you subscribe to this channel and hit that bell so you get an email notification when our next video comes out. We publish every single day, going over markets, hanging out, having a great time, learning, loving. I'm recording this on Valentine's Day, so you know I feel nothing because I have complete control over my emotions. You can too if you get that guide. But okay, subscribe, and I will see you in the next video. Stay fallible out there. Bye.